Hey guys, it's Brandon here. Now, the next commercial investment that you make, the next piece of commercial real estate that you buy, you're either going to make money or lose money. So you got to listen to me. I'm about to show you a multifamily property that allows for both short-term and long-term rentals. Yes, it has 4 units. It's walking distance to the beach. It allows you to pivot if it allows you to hedge against an uncertain market fluctuation. Let's say that the short-term rental market starts to decline. Well, guess what? Now you can shift into long-term rentals. Let's say that you're doing short terms in 2 of the units and long terms in 2 of the units. Well, you're hedged either way. This property allows you the flexibility to be able to pivot and also get the upside of short-term vacation rentals. It is a phenomenal investment, and I can't wait to run all the gross rental income numbers with you, all of the operating expense numbers, your capital gains tax, your capital gains recapture tax, your straight line cost of recovery, owning it over 5 years, the recapture tax on that. I'm going to cover all of the ins and outs and the financial analysis that you need on this property in order to make an informed decision in this video right now. Let's get into it. We are on site today at 215 28th Avenue South. Now, this is a multi-family property. There are 4 units. I'm going to take you on the outside of the units first, then we're going to go on a tour of the inside of one of the units. Before I do, I want you to notice something really quick. See that right there? That's the ocean. That's how close you are to the ocean at this property. Now, there's a unit downstairs and a unit upstairs, obviously. I want to really quick show you there's also a vacant lot. The powerful thing about this property is it allows for both short-term and long-term rentals. This is the other 2 units. Of course, the vacant lot is what I'm walking through right now. Just want you to get a good visual. Now, the scenario that we're going to run for this property today on this video is going to be for short-term rentals. We hopped on AirDNA and we got a rental projection of $46,700 per unit with an average occupancy of 60% at an average daily rate of $214. Now, all of these units are 2-bedroom, 1-bathroom. They range from 751 square feet to 1,000 square feet. They have range, stove, oven, refrigerator, all that kind of stuff. And I will tell you that the asking price on this property was $1,652,211. Now let's dive into those numbers. Now you can see in the screenshot on your screen, all the units there, 1 through 4, are two bedrooms, 1 bathroom. They each having that $46,700 gross rental income projection number brings you to a total for the year of $186,800. Again, we're at 60% occupancy rate and that average daily rate $214. All right, now I want to draw your attention to the top right corner of your screen on the split screen, on the other side of the screen. Your purchase price was $1,652,211. Your acquisition cost were $33,044. That's a 2% broker fee for handling this transaction. Then you've got your loan cost of $24,783. Again, that is going to be 2% of the loan amount for this property, which is not the same as the purchase price because you are going to have to pay that 25% down. Now, if you take your purchase price, you add in your acquisition cost, you add in your loan cost, you take out the mortgage on the property, you're left with your initial investment into the property of $470,880. Now, I'm going to draw your attention to the taxable income section of the spreadsheet on your screen. your potential rental income for this property, if it had 100% occupancy, was $310,667. That's for year one. Now, vacancy and credit losses, we took into account the 40% vacancy rate. So we took that out. That vacancy was $124,267. If you subtract that out from the $310,667, you're left with $186,400, which, if you recall, was the original number that we came up with all 4 units being rented 60% of the time. Now, moving right along, your gross operating income was $186,400. Your operating expenses, we have you at $42,872. If you subtract that from the $186,400, it is going to bring you to a net operating income of $143,528. Now, your interest for year one, the total amount of interest you're going to pay on this loan, financing 75% of it, was $86,141. Moving right along, your cost recovery, it came out to $37,000. That's the amount of depreciation that you can depreciate this unit in year one. Now, the depreciation was calculated by checking into the county assessor's records on the property, calculating the percentage of the improvements to the total value of the property according to the assessor. And the reason why we use the assessor's information is because it's defendable. You know, we're pointing to another source. We're saying, hey, the assessor gave us this, rather than saying we just figured this number out ourselves. So it's a whole lot more defendable if it comes into a question ever. Now, moving right along, we obviously, took into account straight line depreciation for this property and mid-month convention, taking into account that, you cannot, consider the first part of the month that you, in the first year that you purchased the property, and you can't consider the last part of the month in the year that you sell the property. So we took into account that mid-month convention. So that left us at $37,000 in cost recovery that could be taken in year one. Now, moving right along, you're going to also take out your amortization of loan cost. Essentially, we took that $24,783 in loan fees, and we amortize that over 5 years. Now, that's going to give us a real estate taxable income of $15,431. Essentially, we're going to take your net operating income, we're going to take out your interest, which is $86,141. We're going to take out your cost of recovery for the year, $37,000. We're going to take out your amortization of your loan cost, $4,957. And that's going to leave us with the taxable income that we have on this property in year one, which was at $15,431. Now, our tax liability ended up being a total of $5,709. That's 37% tax rate on the $15,431. Moving right along, let's take a look at your cash flow. Now, your net operating income again was $143,528. Your annual debt service was $105.97. That's your annual payment times 12 for the loan at 75% of the purchase price. Now, if you take your $143,528, your net operating income, and subtract out your annual debt service, you are left with a cash flow before taxes of as much as $38,431. If you take into account your tax liability at 37%, that's $5,709. Subtract that $38,431, and it is going to leave you with a cash flow after taxes of $32,721 in your first year. Now, for years 2 through 6, essentially we escalated the potential rental income by a 2% increase each year. Now, can we guarantee that? No. Can we ever guarantee future profits? No. In our mind, based on inflation, we're going to be increasing our rents. So there's a 2% escalation. My tie is running away from me. All right, so moving right along to vacancy and credit losses. Again, those increased again based on that same 2% scale. And your gross operating income came up again to 190, 128 in the second year, and of course increased again based on that 2% increase in your potential rental income. Now, some other things I want you to notice is your cost recovery in years 2, 3, and 4 were a little bit higher than, a little bit lower than in years 1 and 5. This is because in the year that you purchase the property, you have to honor the mid-month convention for the cost or recovery calculation. In the year that you sell the property, this presupposes that you're going to sell the property in year 5. Again, you have to honor that mid-month convention. So those years, you're not going to be able to claim quite as much depreciation on the property. However, in years 2, 3, and 4, you are going to be able to claim the full amount of depreciation because you don't have to account for mid-month convention. Now, I want to draw your attention again to the cash flow section of the spreadsheet. Your cash flow after taxes is going to steadily increase every single year through year 5, and it would potentially increase through year 6, again, keeping with that 2% escalation in potential rental income. What makes these units utterly unique in the multifamily world is they can be used as both short-term rentals and long-term rentals. Yes, you heard me correctly. So if the market fluctuates in the vacation rental space market, in the tourism demand, then you can pivot into long-term rentals. So this property can be evaluated one of two ways: short-term rentals or long-term rentals, depending upon what your strategy is. Now, our market here has over 20 to 22 million tourists that visit each and every year. It's also the fastest growing market out of the 150 most populated markets in the entire US for the last 3 years in a row. So, in my opinion, a property like this right here is positioned well to appreciate and grow in value over time in the next 10 years because our market is blowing up. Baby boomers are retiring at a rate of 10,000 per day, and they are moving to Myrtle Beach and to Florida. And out of those two places, they get more for their money, a better value in Myrtle Beach than in Florida. So it's causing our market to really, really blow up. I get calls and emails pretty much every day, all the time, from investors just like you looking to invest in commercial real estate deals, in short-term vacation rental properties, no matter what it is. If it is real estate, whether it's industrial, office, retail, medical office, I don't care what it is. If you want to invest in it, then you need a savvy investment broker to run financial analysis, market analysis, and feasibility studies on your investment to make sure that you are making a worthwhile investment. No matter what market you're in, pick up the phone and give me a call. It's 843-360-1737. All right, let's get inside this property. Let's check out one of these units. All right. As soon as we come into a living room. There's a custom bookshelf there, closet, or a family room, and a sit-in room. Now, straight ahead, we do have a room this way. We have the restroom in the middle, services both rooms, and a room this way. Let's start here. Pretty standard. And you've got your restroom. You do have a tub shower combo, you can see. And your own window. Kind of overlooks that vacant lot out there. And then finally you have your other bedroom. Both of which have closets. Finally, you have your kitchen, as you can see here. Pretty spacious. Beautiful windows that wrap around, as you can see, absolutely stunning. And then you have a rear porch and stairs here that take you out of the property. As you can see, overlooking the vacant lot in the middle, and of course, beyond that tree branch, your other units. We're going to change gears and look at the alternative cash sales worksheet. Now, guys, this worksheet is going to tell us several different things. It's going to tell us the calculation for the adjusted basis. It's going to tell us the calculation for the capital gain on sale. It's also going to help us understand how much the property appreciated, which is that capital gain, and the sales proceeds after tax. Now, let's tackle the first part of this, the calculation of adjusted basis. The basis at acquisition, that $1,685,255, that is going to be your initial purchase price plus the acquisition cost. Now, we do have the cost recovery taken over the life of the investment was $189,813. If you subtract that from the basis at acquisition, it is going to leave you with an adjusted basis at sale of $1,495,442. That is our adjusted basis at sale. Now, we're going to move right along to the calculation of capital gain on sale. The sale price, again, was that $1,685,255. The cost of the sale was $33,705. That's 2% for broker fees. The adjusted basis at sale, again, we just calculated that, was the $1,495,442. Now, if we take the 1.6, which is the sale price, we take out, the sale price, we take out the cost of sale, we take out the adjusted basis, we are going to be left with the gain or the loss on the property. So that gain was $156,108. Additionally, we're going to step up and plug in that total cost recovery taken throughout the life of the investment. That was $189,813. Now, the difference there is the capital gain from appreciation. You can see that that number is negative. In other words, we were able to depreciate this property more than it appreciated. Now, we're going to move right along to, I don't want to skip real quick, your unamortized loan cost. We've got that over the life of the loan, that $24,783. And then our ordinary taxable income after that 5-year period was a negative $58,488. In other words, we didn't have taxable income for this property. Now, at the bottom there, we have the calculation of sales proceeds after tax. So we have our sales price of $1,821,460. That's $1,821,460. Now, the way that we arrived at that price, I kept this simple and easy. I kept the cap rate at 8.7%. Currently, it has an 8.7% cap rate based on my calculations. So I'm saying if things stay the same from year one and you own it for 5 years and sell it in year 5, if things stay the same, but the net operating income continues to increase on that 2% scale, then this property will be worth, in my opinion, $1,821,460 in year 6 when you sell the property. Now, so we also have the cost of sale in year 6 when you sell it of $36,429. That's 2% of that $1,821,460 sales price. Now, we also have to take out the mortgage balance. Obviously, if you're selling the property, you're going to have to pay off that loan. Now, that balance is $1,129,644. So if we start with the $1,821,460 sale price in year 6, we factor in the cost of paying brokerage fees of $36,429. We also pay off that mortgage. We are left with a sales proceeds before tax of $655,387, we have our tax savings. I used a 37% tax bracket. So of line 16, we had ordinary taxable income of $54,488. Well, 37% of that is going to put us at $21,641 for our ordinary income. Then we also have to pay what's called recapture, straight line recapture tax. Now, the government is going to want 25% recapture tax on the cost recovery that was taken throughout the life of the investment. So essentially, you'll see here that line 11 was $189,813 in cost recovery taken over that 5-year period. Well, they're going to want to get 25% of that back when you sell this property. That's going to bring us to a total of $37,963. Next, there's the tax on capital gains recapture. Now, that is going to be 20% of line 13. Line 13 was $33,705. It was a negative number, and 20% of that left us at $8,426. Now, if we take our sales proceeds after tax, we take out our ordinary taxable income, we've got to pay the government that 37% tax rate on our income from the property while we owned it. We've got to also take into account the straight line recapture that we've got to pay the government, the IRS, for depreciating that property. We've also got to make sure that we pay them 25% of our capital gains. They want that recapture as well. If we take that out of the sales proceeds before tax, we are left with a sales proceeds after tax of $647,491. You can see that this very well could be an extremely profitable investment, and it's standing right behind me, only a walk, a short distance to the beach. Now, regarding how I ran your mortgage numbers, you'll see on your screen there, I've got you at 12 payments per year. I have you amortized over 25 years. I have a loan amount of 25% of the purchase price. That's $1,239,158. Then I've got you at a 7% interest rate, which it could be less, it could be more, it depends on several factors. So I've got your periodic payment at $8,758.11. And then you can see if the loan played out, for the full 25 years, what those payments would be for your interest, what the principal payment would be, what the balance each year is. Of course, I'm assuming that you're going to have a 5-year loan term on a property like this and then have to find additional funding or have the property paid off. Now, I am super excited to talk to you about this next screenshot, guys, because it's got your numbers on it, man. It's got your internal rate of return. It's got your net present value. It's going to show you what this investment is really worth to you. Now, let's say that your year zero cash flows are, again, that initial investment. You're gonna have to shell out that $470,880. Well, year one, you had those cash flows that we looked at $32,721 that you brought in. It wasn't negative, it was positive. Then year two, $34,616. Year three, $35,917. Then $37,216. And finally, $37,916 in year five. Then in year 6, when you sell the property, or at the end of year 5, you sold it and we looked at your numbers, you made $647,491. Well, if you have a discount rate of 12%, a hurdle rate, like 12% is what you're wanting to get out of this investment, then you can calculate what the net present value of this deal is to you. Now, when I ran those numbers, it shows us that if your hurdle rate is 12%, the property is presently, based on these cash flows over 5 years, it is overvalued by $24,066. In other words, you don't have to buy the property any cheaper in order to achieve that 12% hurdle rate. And in fact, you are to the clear, or you are in the surplus as much as $24,066. Now, your internal rate of return on this property was 13.27%. Come on. Now, the really great news for you is that there are only 2 other properties that have ever sold in our MLS that are listed like this, similar type properties that are not apartment properties east of Business 17. So as you can see, guys, there's not much competition. Now, of the people that are listed, I've checked them out on AirDNA. One of them has a potential rental income of $91,900 a year. Come on. That is a 50% occupancy rate at a $506 average daily rate. That's based off 5 bedrooms, 5 baths, and that's over at 200 North Kings Highway. Then the other property on AirDNA, bear with me, that's over at 300 Poinsett Road, right here in Myrtle Beach, had a projected revenue of $33,200 per year, 58% occupancy, $158 average daily rate. That's a 3-bed, 3-bath. So in my opinion, this property is one of a kind in Myrtle Beach. Now, there are apartment complexes located east of Business 17, but this is not technically an apartment complex. So this has a very different audience, a very different renter, a very different guest, a very different tenant. Now, it's the only 2-bedroom, 1-bathroom units of its kind. The other place has 3-bedroom, 3 baths. The other place has 5-bedroom, 5 baths. This is the only 2-bedroom. So this is in that smaller segment of the market. It's a completely different demographic that's going to rent and use a property like this that's only walking distance to the beach versus a 5-bedroom, of course. You know, those much larger groups, or even a 3-bedroom, those larger groups that need a lot of space. So I believe that you have a unique opportunity in our market with a property like this to buy this kind of property, put some money in it, obviously buy it under the ask price, put some money in it, fix it up, and turn it into a short-term rental dream. Now, I want to cover with you some of the advantages of investing in multifamily properties in Myrtle Beach, South Carolina. But before I do, I want to talk to you about the brilliant part of this property that I can't get over. Market fluctuations. If the market fluctuates, guys, and short-term rentals start declining or don't work well, you are diversified and hedged against it in the sense that you can turn right around and rent these out for long-term rentals. You can put somebody in there for 12 months. So this property can be used as a short-term rental property, but it can also be used as a long-term rental property, which really, really greatly reduces your rent. How many multifamily properties have you come in contact with that you have the ability to do both short-term and long-term rentals, which gives further credence to the value and the unique proposition that this multifamily property offers. Now, as I've already mentioned, we have some pretty strong rental demand in our market, between the 20 and 22 million tourists that visit our market each year. We have mainstream tourism. You know, we are the value investment. So people vacation here because they can get a good deal and they can get a lot more for their money as opposed to going to Florida or other places on the East Coast. This is the #2 vacation destination on the East Coast. Now, additionally, multifamily properties can be great. Now, that's why it's an excellent short-term rental property, but let's also examine why it's a great multifamily property. Well, there's a growing local economy here due to the major influx of retirees and remote workers. So there's basically year-round demand for properties like this. Our market has extremely expanded. They're building houses like it's going out of style, and baby boomers are retiring at a rate of $10,000 per day. They're moving to Myrtle Beach into Florida, and they get more for their money here. So multifamilies like this are a phenomenal investment. Now, high cash flow potential. You know, compared to major markets, our property prices are a lot cheaper. So you can invest in a market like Myrtle Beach and spend a lot less in your initial investment cost. And because our rents are pretty competitive, it's going to increase your cash on cash return. Now, short-term rentals can really increase the upside in a property like this. Let's say that you did 2 of these units as long-terms and 2 of them as short-terms. Well, guys, you have a great year in short terms and you've brought in 20, 30% more rental income. It's an excellent way to play the market. I get calls and emails pretty much every day, all the time, from investors just like you looking to invest in commercial real estate deals, in short-term vacation rental properties. No matter what it is, if it is real estate, whether it's industrial, office, retail, medical office, I don't care what it is. If you want to invest in it, then you need a savvy investment broker to run financial analysis, market analysis, and feasibility studies on your investment to make sure that you are making a worthwhile investment. No matter what market you're in, pick up the phone and give me a call. It's 843-360-1737.